Hi there. In this video we'll be starting off with the 13th chapter, that is budgetary system. See, what do you understand by the term budget? What is a budget? Budget is like a statement that we prepare. Budget is like a statement that we prepare wherein we set out the targets we are planning to achieve, right? Yes. So we set out our plans and targets in financial terms. So when it comes to financial terms, what we set is our plans as to what our expenses are going to be and what our target income is going to be. Correct? So we set a plan and target for the expenses and income that is going to come forward or that is going to come to us in the future period, and we make a complete blueprint based on this particular plan, and that blueprint is called a budget. Correct? So it goes without saying this is an item of planning, right? So whenever there is plan, there is a term that is very synonymous with plan or always goes along with the term plan in management accounting, and that is control. So planning and control, they go hand in hand. I'll tell you how. When it comes to budget, say I am budgeting my next month's sales, my next month sales to be $1,000. Okay, now that's my budget. My actual sales was $1,800. Okay, so I got much more than I planned. Yes. So I'm going to take a control measure here. And what I'm going to do is, when I'm setting the target for the month following, I'll set a target wherein I give an increment to it. So I set 1000, I achieved 1800, right? So that means if I set somewhere around like 1800, I will be able to achieve it. So I'm going to set a budget wherein I'm setting it as my next month, the following month sales as 1800 or $2,000. This is my budget. My actual came around at $1,900. Alright? Yes. So saw how I set a plan based on the actual performance. I controlled it and I set another plan. Yes. Now this is what we are going to learn in this chapter. How we use budgeting, how to set budgets and how they aid in decision making and controlling. Alright. So let's quickly look at the blueprint of the chapter. So we first have planning and control in the performance hierarchy. This is just a pure theoretical topic. Then we go to the interesting area, budget systems, where we learn about a lot of budgets. Around how many? 9 budgets are there. Then we go to an area wherein we learn about sales budget information, product budget, production budget information. Then how do you change budgetary systems? And finally, the risks or uncertainties in budgeting. Alright, fine. So 5 subtopics. First one and the second one we'll be dealing with this video. I'm not sure whether I'll be able to finish off the second topic of budget system completely in this video because I don't want the video to be too long. I'll do one thing. I'll teach you what planning and controlling in the performance hierarchy is in this video, along with some topics from the second topic, that is budget systems. Okay, so let's quickly head on to it. So there is nothing much I need to tell you right now as to what a budget is, right? So anyway, let's read what's mentioned here. A budget is a quantified plan of action. It's a quantified plan of action. That's very important because you give numbers to it for the forthcoming accounting period. So in our example, it was a month. Note that budget is a plan, but it is always a plan of what the organization is aiming to achieve and what it has set as a target. So it is a target as well. Whereas a forecast is an estimate. Forecasting is always an estimate of what is likely, what might happen in future. Also, always understand you need to have the terms plan and target when it comes to budget. Okay. So control. The first topic is control. Before that we have a line. Planning and controlling occurs at all levels of the performance hierarchy. It's basic theory. Just read it. Control. Consider how the activities of planning and control are interrelated. Plans set targets. Control involves two main processes: measure actual results and take action. The same example I told you, right? So you set a plan, you measure actual, check whether there is any variance, you control, take another action. Yes. So it goes without saying, controlling is impossible without planning. I told you they go hand in hand. You can only control when you have a plan. right? Now, how do you control from a plan, or how do you control actual results? It's based on feedback. So you get feedback. So from last month, I understood my sales was set at 1000 as a budget. I got 1800. So the feedback was, I set my budget a bit too low. I need to increase it, right? So this is feedback. All right. So feedback can be of three types. It can be negative, positive, or feed forward control. Let's just stick with negative and positive for now. Here in what is the feedback? Was it negative or positive? I said 1000, I achieved 1000 and went much beyond it. That means my action went along with the plans and achieved much more than the plan. That is positive, right? Say next month I'm controlling and I'm setting a budget of 2200, but I'm only achieving 2000. So what is the feedback? Is it positive or negative? It is negative, right? Because I'm not achieving my targets, right? So that's the difference between negative and positive feedback. Feed forward control is control based on forecast result. All right. In other words, if the forecast is bad, control action is taken well in advance of actual results. Just that you forecast something, and if you forecast that things are going to be bad, you bring about control there. That is feed forward control. Clear? Yes. So that's pretty much about feedback. Now there are two kinds of feedbacks that are mentioned here: single loop feedback and double loop feedback. Single loop feedback is like a thermostat which regulates the output of a system. For example, if sales targets are not reached, control action will be taken to ensure that targets will be reached soon. The plan or target itself is not changed, even though the resources needed to achieve it might have been reviewed. So in single loop feedback, you always remember plan or target is never changed. Okay, clear? The things that are changed are whatever resources, whatever inputs that were given to achieve this plan and target, they are changed. Okay, fine. Now, double loop feedback is of a different order. If the information, it is information used to change the plan itself. Here you change the plan. So say I set my target as 2000. I was 2200. I only achieved 2000, right? In single loop, what I would do is I will change my inputs to the actual so that my 2000 gets increased to 2200. But in double loop, what I do is I change my budget, I reduce it to 2000 or something that is achievable. Alright, that's the difference in single loop and double loop. Okay, for example, if sales target are not reached, the company may need to change the plan. Alright, now controls at different levels. See, you know, an organization is divided into three levels of managerial controls. That is operational level. Above that there is management control, and on top of everything, you have the strategic level. So in operational level, you control day-to-day operations. Yes, say it's a factory, you control every day what is being produced, how much is being produced, what is the quality of the items being produced, right? In management control, it is the next level. Say the production department verifying or testing their 1 month analysis report. They are analyzing their performance report. Okay, they analyze their employees efficiency report. These are all done on a monthly basis. Strategic level is something that's done in the top level management, wherein for a quarter or for 6 months or for a full year, so it can be for a year, it can be for half a year, it can be for 3 months, a quarter, wherein the company reviews, have we achieved our target for the quarter? Did we get things done which we planned for the first half of the year? Is our business plan going well? Is our strategic position in accordance with the market? Things of that sorts. Okay, so you bring about controls to running the whole company in a long-term view. In operational level, you bring about controls to run the company on a day-to-day basis. In managerial level, a middle-term basis. All right, clear. Next, top-down and bottom-up budgeting. So as I said, we have strategic, management, and operational. Right, strategy being top, operational being bottom. When you set budgets from strategic to operational, that is the top management decides the target. They pass it down to management level. Now they discuss and set their departmental targets, and they pass down their operational managers, and their operational managers set day-to-day tasks. That is top-down approach. Whereas bottom-up approach is different. The operational level sets their tasks and targets first. They pass their targets to their management, their departments. Their department heads review it and set it for the department targets, and the department heads review it and pass it to strategic level, and the company sets their long-term targets. That is the difference between top-down and bottom-up approach. So it goes without saying, the easier one would be top to down, less time consuming, right? easier to do. Bottom up will require a lot of time consumption because there'll be a lot of operational managers. They'll have to discuss, find ways to do, achieve targets and everything. Yeah, so that's the difference. And at times bottom up will be much better for the company because managers who actually do the work are from bottom and they know which is easily achievable, which is better for the company, right? So that's pretty much it for the initial theory. Now we are moving on to the super interesting area, budget systems. All right. So under budget systems, we'll be learning about multiple kinds of budgets: fixed budget, flexible budget, flexed budget, and there are still more, 6 more left, I think. Yeah, there's 6 more exactly. Okay, I think I'll stop at flexible budget for now. Okay, I'll stop it at flexible budget. Okay, I'll go to the next ones, the next 6 or 5 ones in the next video. Right. So in fixed budget, what is a fixed budget? As the name suggests, there is something fixed. It's not going to change. All right. A fixed budget is a budget which remains unchanged throughout the budget period, regardless of differences between the actual and original planned volume of output or sales. Regardless of difference between actual and the original planned volume. So we will not change even if there is difference between actual and planned value. Okay. The fixed budget is the master budget. And it's prepared before the beginning of the budgeting period. Prepared before beginning of the period. It is based on budgeted volumes and cost revenues, and as such is often unrealistic as the actual level of activity will be almost certainly different from level of activity of the originally planned period. Alright, what it means is, say I'm setting my target for the next year. Oh sorry, it's for this particular year. I'm setting for the remaining 11 months of my year 2023, I need to achieve a sales or turnover of $1 million. And I'm not going to let it change. That's fixed. I need to achieve it. And that's a fixed budget. It's for a long period. Now this might be unrealistic because as time passes, things might change. There might be change in circumstances. There might be change in market conditions and everything. So these changes might make it really unrealistic to achieve this fixed budget. All right. Now the major purpose of fixed budget is for planning, just for planning. And it is prepared at the planning stage when it is used to define the objectives and targets of the organization for the budget period. Clear? Now flexible budget is the opposite of fixed budget. Flexible budget is a budget that can change. Now what is the highlight here? The highlight here is change. Whereas in fixed budget, no change. So what flexible budget tells you is, we will recognize the changes in cost, like cost behavior changes, cost behavior patterns. We'll recognize these changes, and based on that, we will allow provision to change the budget. So it is a budget which, by recognizing different cost behavior patterns, is changed as volume of output and sales changes. So we know the more we sell, the more the changes in our cost behavior, right? It recognizes cost behavior patterns such as changes in sales revenue and variable cost. We know the more the sales, the more the variable cost. As sales volume change and step changes in fixed cost as activity levels rise or fall by more than a certain amount. Yes, we had discussed this in the initial chapters. We know variable cost will directly change, is directly related with sales. The more the sales, the more the variable cost, right? Whereas fixed cost does not change up to a certain level, right? So what flexible budget tells you is, we will consider the costs. We will consider how these costs changes. And from this consideration that we are doing, we'll find out a pattern on how these costs are changing. All right. So in flexible budget, we will consider cost. We'll consider its changes. From this changes, we will draw out a pattern. All right. Fine. And based on this pattern, we'll plan. So a flexible budget is used at planning stage to show different levels of results from various possible activity levels, allowing better planning for the uncertainty in future. So based on this pattern, we will set a budget. So this pattern will give different levels. Yes. So we'll consider all these different levels in this budget. Fine. Next, flexed budget. Yes. Now, what is a flexed budget? What do you mean by the term flexed? Flexed means changed, right? It's already changed. A flexed budget is always a revised budget. Sorry. Flexed budget is a revised budget. Okay. Flexible budget is a budget that is designed at planning stage with varying activity levels, with different activity levels to vary with activity levels, right? Whereas a flex budget is a revised budget that reflects the actual activity levels achieved in the budget period. A flex budget is therefore used retrospectively to compare actual results achieved with what results should have been under the circumstances. Okay? So always understand, fixed and flexible is set at the planning stage. Yes, is set at the planning stage. Now what is a flexed budget? Flexed budget is a budget that has been changed. Now how do you change a budget? When you control, right? So this is not set at planning stage. Flexed budgets are always set at control stage. Fine? Clear? Now we have a small theory area which states the purpose of flexible or fixed budgets. I'll just suggest you guys to read it. You read it, and if you have doubt you can ask me. Now we'll go to the first illustration. Prepare a budget for 2026 for the direct labor cost and overhead expenses of a production department flexed at the activity of 80%, 90%, and 100% using the information listed below. Okay, they want to prepare a budget for their labor costs and overhead expenses. So they want their labor cost covered and overhead expenses covered of production department. Now they tell us that the direct labor hour rate is expected to be $3.75 per hour. Yes, 100% activity represents 60,000 direct labor hours. So at 100% it means we have 60,000 hours. They have asked us to prepare at 100%, 90% and 80%. At 3 levels we need to prepare, right? The variable costs are as under: indirect 0.75 per direct labor hour, consumable 0.375 per direct labor hour, canteen and other welfare 6% of direct and indirect labor cost. So you take 80% for example, or 100% for example. 100% example, so let me just open an Excel file. So I'm preparing statement showing budget of direct labor hour costs and overheads of production department, and this is flexed at 80%, 90% and 100%. So particulars, budget levels of 80%, 90% and 100%. So 100% we know the hours. Hours is 60,000 hours. So 90% will be 60,000 into 90%, that is 54,000. And at 80% will be 60,000 into 80%, that is 48,000. Right? So I'm going to list down all my costs for these 3 levels of activities. So we have variable cost mentioned here, we have semi-variable cost mentioned here, couple of stuff are semi-variable, and then we have fixed cost mentioned here as well. Okay, let's prepare a budget. Calculate the budget cost allowance for 2026 assuming that 57,000 direct labor hours are worked. Okay, that's the second question. There is question number 1. They have also asked us to prepare 57,000, another report with 57,000. Okay, right. So let's do the first one and I'll show you sample. Based on that you can do the rest. So what are the different costs that we are incurring? We are incurring variable costs. So first variable, we have 3 items. What are the 3 items? Indirect labor, direct labor, indirect labor, supplies, canteen. Direct labor, indirect labor, supplies, canteen. Yes, now direct labor is at 3.75 I reckon. Yeah, $3.75. Indirect labor at 0.75. Consumables at 0.375. And finally, this is 6% of canteen is 6% of direct and indirect labor cost. Okay, 6 percentage of DL plus IDL. So I'll just do it for the 100% level. Here it will be 60,000 into 3.75, correct? Here it will be 60,000 into 0.75. Here will be 60,000 into 0.375, and here it will be 6% of this plus this. Okay, so I got a total variable costs. Now we have semi-variable costs. Okay, let's check what all we have here. Okay, they're just given single semi-variable cost for different levels of activities. Now do you remember we learned the top-down method? See, what is semi-variable cost? Semi-variable cost is a cost which is fixed cost plus variable cost. There is a fixed and a variable component. Now how do we find the fixed cost and variable component? What we do is we take the top-down method. So to take the top-down method, to do the top-down method, we take the top values. Top values, and we take the bottom values. So out of this data given, which is the highest hours we have? We have 64, 59, 53, 49, 40. Okay, this is the lowest and this is the highest. Correct. So 64 and 40. So 64,000 hours, 40,000 hours. Correct. The costs are for the same at 2,800, 16,000. 2,800, 16,000. Just take this and put it right on top. Yeah. Now what is the difference here? 64 minus 40, and here it is 2,800 minus 16,000. So from the difference we know, so this was hours, this is cost. From this difference we know variable cost will be, variable cost per hour will be, what is the cost here? 4,800 divided by 24,000. It will be 0.2. It will be 0.2. Variable cost per hour is 0.2. Now I'm going to apply it in this top value. This top value. So top value we had cost of 2,800. Yes, this is equal to 64,000 into 0.2. Variable cost component. Yes, variable cost component into 0.2 plus the fixed cost component. Correct? Yes. So what is a fixed cost component? Fixed cost component will be this 28,000 minus 64,000 into 0.2. So what is it? 15,200. Yes, 15,200. Sorry, not 28,000. It's 2,800. Sorry, 2,800. 2,800 minus 64,000 into 0.2. 8,000. Now I can cross verify it by applying it in bottom value as well. So in bottom value, the hours or total cost was 16,000. 16,000 is should be a total of fixed cost plus variable cost. Variable cost is 40,000 hours into 0.2, that is cost per hour, plus fixed cost, right? So fixed cost will be 16,000 minus 40,000 into 0.2. It will give me 8,000. See, 8,000. So now I got my semi-variable cost formula. Semi-variable cost formula is 8,000 plus hours into 0.2. Okay, that's my semi-variable cost formula. Now to take it here, so here it will be 8,000 plus, how many hours do I have in 100%? 60,000 into 0.2. That is it. That's it. Now I have fixed costs, different fixed cost from the question. How much are my fixed costs? Let me just go to the question. Sorry, where is the question? Yes. What are my fixed costs? Okay, 18, 10, 4, 15, 25. Just list it out. 18, 10, 4, 15, 10, 25. 15, 25. Alright, now this doesn't change. This particular value will be same for all levels of production. This I can copy, paste it here and paste it here. It won't change. Alright, fine. So my total cost will be sum of 4,07,000. Alright, that is going to be my total cost. 400,700. Right. Just cross verify what they've got. Yeah, see, that's what they've got. As simple as that. Yes, very easy. So what I would suggest you guys to do is just try it out. Just try it out for the rest of the 90%, 80% as well. Here all you have to do is for variable 54 into 3.75 into 0.75 into 0.375. Yes, that's all you have to do. And here what you have to do is, here all you have to do is 48,000 into 3.75, 48,000 into 0.75, 0.375 and 6% of these two. Here it is 8,000 plus hours into 0.2. You'll get this and this. And just add it up, you'll get the answer. That's all. So that's all for this particular question. Very simple, right? Very simple, nothing much, just repetitive work, right? So that's all. Now after this, what do we have? We have an activity as well, very similar. I would suggest you guys to do this activity on your own and then find out the answer. If you have any doubt, you can ask. Now we are moving on to incremental budgeting. Alright, I'll do one thing. As I said, I'm stopping the video here. Incremental budgeting and the ones that follow. So we have incremental budgeting, should be zero-based budgeting. Yes, zero-based budgeting next. Afterwards, we have zero-based budgeting is kind of important. You have a lot of theory and everything. Rolling budgets. Rolling budget is there. Then what do we have? Rolling budget is very simple. We have activity-based budget. That's also very interesting. Very interesting topic. Yes, and beyond budgeting. So we have 4 or 5 more items that we'll discuss in the next video. Okay. So alright then, I'll see you in the next video wherein we discuss about incremental budgeting, zero-based budgeting, activity-based budgeting and rolling budget. Okay. So yes, I'll see you in the next video. If you have any doubt with what you learned here, please do reach out. Thank you and bye.